So, you want to own a chip fab, not a chip company, not a chip brand, the actual factory. The building where the chips inside every AI server on Earth are physically made. On paper, it sounds like the best business alive. You're not selling a product people might not want. You're selling the one ingredient every AI company on the planet is currently begging for. NVIDIA needs you. Apple needs you. Every government trying to build a sovereign AI industry needs you. Demand isn't a question anymore. It's a certainty, stretching out for years. So you build the fab. You sign the deals. You watch the machines get installed. And within 18 months, you could be sitting on one of the most powerful economic assets in the modern world. Or you could be sitting on a $15 billion hole in the desert, bleeding money every single day it sits half finished. Both of those outcomes have happened to real companies with real money. And the difference between them isn't luck. It's a set of brutal economic mechanics that almost nobody outside the industry actually understands. Because here's what makes this business so strange. It looks like a manufacturing story. Steel, concrete, machines, output. But underneath, it behaves more like owning a nuclear reactor crossed with a casino. Enormous fixed costs, razor-thin timing windows, and a single piece of equipment so scarce that one company on Earth controls whether your factory can function at all. This is the story of what it actually costs to own the machine that builds the modern world, and why almost nobody who tries succeeds at it. From the outside, the pitch is almost embarrassingly simple. AI is the biggest technology boom in a generation. Every AI boom needs chips. Chips need factories. Whoever owns the factories controls the supply. Control the supply, and you control the money. It's the same logic that made people fall in love with owning oil wells, toll roads, or beachfront hotels. You're not betting on a trend. You're betting on the plumbing underneath the trend. NVIDIA might rise or fall. OpenAI might win or lose the AI race. But somebody, somewhere, still has to physically manufacture the silicon that makes any of it run. And the headline numbers make it look like a foregone conclusion. Demand for advanced chips is so far ahead of supply that the world's biggest chip maker recently raised its own spending plans to more than $60 billion in a single year, just trying to keep pace. Orders are booked years in advance. Customers aren't negotiating on price. They're begging for a place in line. So the fantasy writes itself. Build the factory, and the money finds you. It's the kind of story that makes owning a fab sound less like running a business and more like owning a printing press for the future. Which is exactly why almost nobody stops to ask the more uncomfortable question. If this business is such an obvious gold mine, why has it, historically, bankrupted, humbled, or quietly buried far more companies than it has made rich? Here's the reframe. A chip fab isn't really a chip business. It's a precision timing business wearing a manufacturing costume. Think about what actually happens inside one of these buildings. You're not stamping out identical parts on a line, like a car factory. You're trying to print features onto silicon wafers that are, in places, only a few atoms wide, using light. Using vibration-isolated rooms, so precise that a truck driving past outside can ruin a production run. Using chemical purity levels so extreme that human breath in the wrong place can destroy a batch worth millions. And you're doing all of that on a technology curve that moves so fast. The machine you install today can be functionally obsolete in 3 to 5 years. That's the real business. Not make chips. It's spend tens of billions of dollars to build a facility precise enough to manufacture the most complex objects humans have ever mass-produced, and do it fast enough and reliably enough that the technology hasn't already moved on by the time you're finished. Miss that window even by a year or two, and you haven't built a factory. You've built an extremely expensive museum. And there's a deeper twist most people never see coming. Even if you build the perfect fab, on time, on budget, you still don't fully control whether it can run. Because there's one machine, made by exactly one company on Earth, without which the whole building is just an empty shell. We'll get to that machine. It's the real choke point hiding behind the choke point. But first, you have to survive just getting in the door. Let's talk about the price of admission. A single leading-edge fab, the kind capable of producing the chips inside a modern AI GPU, costs somewhere between $15,000 and $35 billion to build and equip, depending on the process node and scale. That's before a single usable chip has come off the line. That's just the building, the clean rooms, the water systems pure enough to rinse silicon at a near molecular level, and the equipment needed to even attempt production. For comparison, that's more than the entire GDP of some countries spent on one building, and that number keeps climbing. The world's largest chipmaker recently pushed its total planned investment in a single U.S. site from $65 billion to $165 billion to $265 billion inside about 18 months. Not because costs spiraled out of control, but because the plan itself kept expanding to meet demand that refuses to slow down. Then there's time. A fab doesn't open on a light switch. From breaking ground to producing usable, high-yield chips at scale can take 3 to 5 years, sometimes longer. You're not just spending tens of billions up front. You're spending it years before you see a single dollar of revenue. And during those years, you're not immune to the world. You need specialized labor that barely exists. Industry estimates point to a shortage of well over 100,000 skilled semiconductor workers in the U.S. alone by the time some of these mega projects are fully online. You need power at industrial scale, water at industrial scale, and government cooperation, because in most countries, a project this size doesn't move without political blessing and often public subsidy. So the real entry price isn't just the check you write. It's the years of exposure before that check turns into revenue, years where currency shifts, technology shifts, and demand cycles can all move against you before you've made a single sellable chip. Which raises the obvious question, if it costs this much just to walk through the door, how does anyone actually make money once they're inside? Here's where the business starts to make more sense, and also where it starts to feel more fragile. The core revenue model is deceptively simple. You don't sell chips one at a time to consumers. You sell manufacturing capacity months or years in advance to a small number of enormous customers, chip designers who don't own factories of their own. NVIDIA doesn't own the machines that make its GPUs. Apple doesn't own the machines that make its processors. They design the chip, and they pay a fab to physically produce it. This is the part almost nobody outside the industry realizes. The most valuable tech companies on Earth are, in manufacturing terms, tenants. The fab is the landlord. And like any landlord with a scarce, desirable property, the real profit engine isn't the base rent. It's what happens when demand outstrips space. When every customer wants priority access to your most advanced production line, you're no longer just charging for chips. You're auctioning off scarcity itself, and the customers who need it most will pay whatever keeps them from falling behind. That's why the newest, most advanced production nodes carry enormous margins compared to older ones. A fab running last-generation technology is basically a commodity business, thin margins, brutal competition, constant price pressure. A fab running the newest, hardest-to-replicate process is closer to a monopoly because for 2 or 3 years, almost nobody else on Earth can make that exact chip at that exact quality. That gap between commodity node economics and bleeding-edge node economics is the entire business in miniature. Old technology, survive. New technology, thrive. Which is exactly why the smartest operators don't just build fabs. They build a pipeline of fabs, constantly retiring old capacity and racing to open new capacity, because standing still on the technology curve is the fastest way to turn a monopoly into a commodity. But there's a catch hiding inside that racing pipeline, because that race depends entirely on being able to buy the tools that make the next generation possible. And that's where the real power in this industry quietly shifts away from the fab owners altogether. Picture this. You've spent $20 billion. Buildings finished. Clean rooms are sealed. Staff is trained. And your entire production line is still useless because you're waiting on delivery of a machine roughly the size of a school bus, built by exactly one company on the planet that costs somewhere around $400 million per unit. That's not an exaggeration for effect. It's the literal reality of advanced lithography. There's one company, a Dutch firm, that has spent decades and roughly $10 billion in research building the only machines on Earth capable of printing the smallest, most advanced chip features using extreme ultraviolet light. No competitor has managed to replicate it. Not a rival firm, not a national government, not a well-funded startup. For the most advanced tier of chipmaking, this single company is not a supplier. It's a gatekeeper. Sit with that for a second. You can have unlimited capital. You can have the best engineers. You can have government backing and a fully built factory. If that one company decides your order goes to the back of the queue, your $20 billion building sits there, finished but functionally powerless. This is the real choke point hiding behind the choke point. The fab owner looks like the one holding all the power, controlling access to chip supply for the entire AI industry. But one layer up, the fab owner is themselves a customer, standing in line, at the mercy of a company that makes maybe a few dozen of these machines a year. It's monopoly, stacked on monopoly. And it explains something that otherwise looks bizarre. Why some of the richest, most powerful tech companies in the world are, at the deepest level of their supply chain, waiting their turn like everyone else. Own the fab, and you still don't own the ceiling above you. Someone else does. Here's the part the fantasy never mentions. Getting the fab built and equipped isn't the finish line. It's the starting line for a completely different kind of financial pressure, the kind that runs every single day, whether you're making money or not. Start with utilization. A fab is engineered to run close to full capacity, constantly. The fixed costs, the depreciation on billions of dollars of equipment, the power, the staff, the maintenance, barely change whether you're running the line at 90% or 40%. But your revenue changes enormously. Drop from near full utilization to half empty, and a business that looks wildly profitable at full tilt can flip to losing money within a single quarter. There's no gentle middle ground in this industry. You're either full and thriving or empty and hemorrhaging. Then there's obsolescence. Unlike a hotel or a warehouse, which can run productively for decades, a fab's most advanced equipment has a shelf life measured in years, not decades. The industry keeps moving to smaller, more precise processes, and a production line that was cutting edge can become second tier within a handful of years, worth a fraction of what you paid, while the debt used to buy it is still very much outstanding. Labor adds another layer of pressure most outsiders underestimate. These aren't factory workers in the traditional sense. They're highly specialized technicians and engineers in an industry facing a well-documented, worsening shortage. That scarcity doesn't just slow hiring. It drives up wages, increases turnover risk, and puts enormous pressure on any company trying to staff multiple new facilities at once. And underneath all of it sits the debt. Very few companies fund a project this size purely out of cash flow. Most lean on a mix of their own capital, government incentives, and enormous borrowing, meaning that on top of every operating cost, there's a steady stream of interest payments that doesn't pause just because a shipment of critical equipment got delayed, or a customer pushed back an order, or a new technology node took longer to stabilize than planned. Put it all together, and you get a business with almost no room for error. High fixed costs, rapid technological decay, scarce, expensive labor, heavy financing. Every one of those forces is manageable on its own. Stacked together, they turn a good year into an enormous windfall and a bad year into a genuine crisis. Which brings us to the part of this business almost nobody plans for until it's too late. Here's an uncomfortable truth about this industry. Being early doesn't protect you, and being big doesn't protect you either. The traps in this business are structural, built into the economics itself. The first trap is timing risk. Because building a fab takes years, every operator is essentially forecasting demand 3, 4, 5 years into the future, and committing tens of billions of dollars based on that forecast. Guess right, and you open into a supply-starved market willing to pay a premium. Guess even slightly wrong, a demand slowdown, a new competing technology, a shift in what kind of chips the market actually needs, and you open into a market that's already moved on. The second trap is technological catch-up. Falling even one generation behind the industry leader doesn't mean modestly lower margins. It can mean the difference between being the company everyone lines up for and being a commodity supplier competing purely on price. History in this industry is full of companies that were once at the absolute frontier and slid to second-tier status within a single technology cycle. not because they got worse, but because staying at the very front requires reinvesting almost everything, every single cycle, with no room to coast. The third trap is geopolitical exposure. Advanced chip manufacturing has become so strategically important that governments now treat it as a matter of national security, which sounds like it should help fab owners through subsidies and support. And sometimes it does. But it also means fab expansion decisions get entangled with trade policy, export restrictions, and political relationships between countries. Shift in policy on one side of the world can suddenly change what equipment you're allowed to buy or what customers you're allowed to sell to. And the fourth trap is the one that quietly kills mid-sized players: scale itself. In an industry where the leaders are spending tens of billions of dollars a year just to maintain their position, a smaller operator without that kind of capital can't simply compete harder. They get squeezed out of the most profitable, most advanced work and pushed down into older, lower margin production, the exact commodity trap the whole industry is trying to escape. This is why the roster of companies that have tried to compete at the very top of this industry and failed is longer than the list of companies that succeeded. The failures weren't reckless. Many were well-funded, well-run, technically capable companies. They simply got caught by one of these traps at the wrong moment, and the economics of the business gave them almost no way to recover. Consider the position one legacy American chipmaker found itself in over the past several years, a company that had, for decades, been synonymous with cutting-edge chip manufacturing. As rivals in Taiwan and South Korea pulled ahead on the most advanced production nodes, that company found itself trying to do something almost unheard of in this industry: catch up from behind, while simultaneously funding the build-out of brand-new advanced facilities, while still trying to convince outside customers to trust them with critical, expensive manufacturing contracts. That combination, playing catch-up technologically, spending at frontier levels financially, and rebuilding customer trust commercially, all at once, is about as difficult a position as this industry can produce. It required enormous capital investment during a period when the company's own manufacturing business was posting significant losses, even as global demand for advanced chips was surging to record highs elsewhere in the industry. It's a vivid illustration of the central tension in this entire business. Being large, established, and historically dominant offers no permanent protection. The moment you fall even one step behind the technological frontier, you're not just competing on price anymore. You're spending frontier-level money while earning commodity-level margins, hoping the gap closes before the cash runs out. Contrast that against the operator who has spent the last several years consistently sitting at the very front of the technology curve, and who is now being handed record profits and unprecedented pricing power specifically because competitors have struggled to keep pace. Same industry, same core economics, wildly different outcomes, determined almost entirely by execution on the technology curve, year after year, without a single serious stumble. That's the business in one comparison. Not chips are profitable. It's staying at the absolute front is profitable. Everything else is a knife fight. Let's make the volatility tangible, because on paper, this looks like a steady, predictable infrastructure business. In reality, it swings harder than almost any other industry of its size. In a good year, and the industry is living through one of its best stretches right now, a leading fab operator can post profit growth well above 50% year over year, driven by AI-fueled demand that's outrunning supply so badly that customers are effectively prepaying for capacity that doesn't exist yet. Order books stretch years into the future. Pricing power shifts almost entirely toward the fab. Margins on the newest technology nodes can be extraordinary because scarcity, not cost, is setting the price. In a bad year, the same business can look almost unrecognizable. A slowdown in end demand, say, a pullback in consumer electronics, or a cooling in a specific segment of the AI build-out, collides with a factory that still has to run near full capacity just to cover its fixed costs. Utilization drops. Margins compress fast. The debt taken on during the boom is still due at the exact moment revenue is softening. Add in a currency swing, an export restriction, or a delay on critical equipment, and a company that looked unstoppable 18 months earlier can suddenly be posting real losses. This is the volatility most outside observers miss, because right now, we're deep inside a good stretch, and good stretches make the entire business look effortless. But the structural traps we just walked through don't disappear during a boom, they just go quiet. They're always sitting underneath the numbers, waiting for the cycle to turn. That's the real signature of this business. It's not steadily profitable. It's spectacularly profitable in the right years, and brutally exposed in the wrong ones, with very little room in between. Step back from the chip industry specifically, and this story is really about something bigger. What it actually means to own the infrastructure behind a technology revolution, instead of the revolution itself. Everyone wants to own the flashy layer, the AI model, the app, the chatbot people talk to. But underneath every one of those things sits a chain of physical dependencies, and at the bottom of that chain sits a small number of companies making decisions that ripple through the entire global economy. A shortage of one type of manufacturing equipment made by one company can quietly slow down AI progress worldwide, regardless of how much money or ambition sits above it. That's the deeper economic truth this business reveals. In industries defined by extreme complexity and extreme capital requirements, ownership doesn't concentrate at the most visible layer. It concentrates at the narrowest, hardest to replicate layer, the actual choke point. Everyone above that choke point, no matter how large or famous, is ultimately a customer. It's also a case study in what real barriers to entry look like in the modern economy. Not a clever brand, not a patent, not first mover advantage. Decades of accumulated, almost unreplicable technical capability protected by capital requirements so enormous that even well-funded new entrants can't meaningfully challenge the leaders. And it's a warning about what happens when a society becomes economically and strategically dependent on a business this concentrated, this capital-intensive, and this geographically narrow. When a handful of buildings in a handful of locations produce the components that modern life increasingly runs on, the stakes of that industry stop being purely financial. They become geopolitical. So, do you still want to own the fab? Because here's the real answer underneath all of it. Owning the factory was never the finish line in this industry. It's simply the price of getting into a race that never actually ends. A race against a technology curve that moves faster than any single company's balance sheet, guarded by a choke point that no amount of capital alone can buy your way past. The chip fab isn't a monopoly. It's a seat at a table where the real monopoly sits one layer above you, quietly deciding whether your $20 billion building gets to matter at all. And that, in the end, is the real economics of owning an AI chip fab. It's not a business you win by building the biggest factory. It's a business you win, for a while, by never, ever falling behind.